Welcome to TMS Insights. We've just done reporting season. It's the start of September and want to bring you all the news from that reporting season and a little bit of forward-looking information as well. Ben Clark and Jeremy Hook with you. Ben, reporting season, pretty good.
Pretty good. No real disasters out there. Minus 1% earnings growth across the market, which was pretty widely expected. You'd have to say we need to start seeing some earnings growth to see the market take that next leg higher. It sort of belies what actually happened in the market though. There was minus 30% earnings growth in the resource sector,
Yes.
positive 5% in the industrial sector.
Yeah.
I think there are still a bit of concerns about the 7 to 9% consensus forecast earning growth across the market for the coming year.
Might be a bit optimistic.
Maybe a bit optimistic, but I think the resources will have a good kickback.
Yeah.
And a couple of interesting points I took out of it. Point number one, listening to a lot of investor briefings, CEOs seemed a bit more upbeat to me,
Yes.
a bit more optimistic. Certainly they gave guidance a lot more frequently
And
than
they
they
hadn't
have.
been doing that, no. in
Through the
last year.
GFC, no guidance whatsoever.
No.
So that's a sign of confidence, I think, in the business. And point number two is the payout ratio in Australia is the highest it's ever been at 72%. So that's the dividend payout ratio. Now that might sound like good news, but it isn't necessarily, because if you're paying out all of your profits as a dividend, you're not investing as much back into the business, which means less earnings growth down the track.
A confident sign, but maybe not suggesting other growth opportunities.
Yeah, absolutely. CEOs effectively saying the best thing we can do is pay our shareholders. And I think trying to attract shareholders onto the register with better dividends.
Yeah.
Invacare was one we wanted to talk about.
Invacare was a classic result in the sense that the top line was up, profit was up about 5% net profit line, and then we saw earnings per share decline, and they declined on the back of weaker revenues at the back end of the year. A timing issue, yes, in this case, because there were actually fewer deaths as the warm winter weather produced a less favourable business environment for them. Difficult to talk about at times.
Grisly business to talk about. Yeah.
Grisly, indeed. But Invacare is a very good business, and we hear a lot of companies say, oh, it's a timing problem, and next reporting season you'll hear better from us. And there are serial offenders like Fairfax. Invacare is definitely not one of those. Its business model is very good.
Yep.
It did fall after that result, not surprisingly.
Yep.
But it is a quality stock. We regard it as a premium one, and one on dips we look to continue to buy. So
No
Invacare,
more certainty than that will kick back up again at some stage.
It'll come around, and that's a good timing problem, not a bad timing problem in the sense. And we'll see better numbers ahead from Invacare. So that one was overall very good, but that explains why it reacted in the market like that. Another one we like a lot is SEK, Ben, and that reported very well.
Very well. Andrew Bassett, I thought, gave a great presentation. The highlights, the domestic employment business, SEK Australia, has grown its earnings by 52% over the last 3 years, despite the unemployment rate being the same now as it was then.
Yes.
And that's, of course, from the move from print to online. And Andrew was saying that he still believes that's still got a fair way to go. 4% a year will continue to come across for the next sort of 5 to 10 years. Think the SEK education business really shot the lights out, earnings up 70%.
Big turnaround there.
Big turnaround. And of course, that's why they built this business, was when employment markets are soft, people go out and educate themselves. It takes the cycles out of their earnings to some extent.
Yes.
And SEK International, another great result.
Division, isn't it? Yeah, growing well.
So that's reporting season. Now there's a fair bit going on at the moment and coming up in the next few weeks. Front of mind, I guess, for some clients is Syria. What do you make of that?
Look, Syria is going to unfold in one of a number of ways. We can't exactly be sure how, but what we most likely will see is whether military action happens or whether Syria just bubbles along unpleasantly. It could cause a negative reaction in the market. The point to make is it's probably not one that will change our view on portfolios, and it may create opportunity. So macro events like this, military events, are more opportunity than anything else.
Yeah.
We've seen that over a long, long period of time. So it's not something that overly concerns us. It's something we're watching and focusing on, but it's not something which will affect our overall portfolio decisions. No. So that's something that will happen between now and the next time we bring a TMS Insights to everybody. And Ben, another thing that will be happening is the Fed tapering in the US.
Yep. And we've got the non-farm payrolls out this Friday, which will give the market some sort of sign as to, is it happening sooner rather than later? I still think this is the biggest event that you need to be aware of in terms of global markets. just because the size of stimulus has been so huge, and the US is totally focused on this issue. But I would say tapering was announced in May. We've had a few months to adjust to it, and I think largely the markets have. There still could be that sort of shock when it's actually going to happen, but by that stage I think it probably will have been mainly priced in.
Well, we've seen it in the bond market. The bond market's already reacted. Bond yields have doubled in the States. It's on the way, isn't it?
It is. And I just think you've got to sort of watch this play out. Bernanke has the ability to speed it up or slow it down as he sees the US economy recover faster or slower. So I still think an orderly exit is very much likely, and it's not something to be overly concerned at, but you must, and certainly will be, paying attention for our clients to it.
And I guess the other thing will be the federal election here.
Absolutely.
So that's going to be resolved on the weekend. And we're going to see, presumably from the polls, a new government and a more confident business environment.
Definitely. I mean, this will be a big shot in the arm, I think, to Australian business that will, at least, regardless of which party you're going for, at least there's some certainty as to who is going to be leading the country. And I think that can only be a good thing. I don't expect the markets to react too much to it. I think the Fed sort of thing is a much bigger issue. But you know what you can be confident about? Yesterday we closed 20 points off a 5-year high.
And that will surprise a lot of people to hear that. So,
but because just to me, it just seems there's a lot of pessimism still amongst investors, amongst fund managers, even clients, sort of people just don't feel things are going that well. But we're only 20 points off the highest the market's been since 2008. That's a big positive. And the market is rising despite the pessimism.
The reality is things are going well in the market.
Slowly recovering.
Well, that's all we've got time for today. We'll bring you another TMS Insights next month, but we look forward to any calls you have relating to anything we've talked about today or any other matters relating to our market.